Hey, my name's Jake Nicholson and welcome to my YouTube channel. In this video, I want to talk about the Bank of England's dilemma next week. You see, the expectations were that there would not be many more rate cuts in 2025. This comes off the back of inflation roaring back to 3.5% and potentially going up even more. But we've had some very bad job data this week, and that means the Bank of England might have to rethink their plans. And in this video, I'm going to tell you all about what the new expectations are for the Bank of England rate cuts in 2025. Now, if you're new around here and you haven't done already, do make sure you subscribe to the channel over there and hit that bell notification. We're on the way to 44,000 subscribers. And by subscribing, you'll get all the latest interest rate news, house price news, and property investing news. And let's get some more views on this video. How do we do that? Smash like, tick a like, do something to the like button. That helps with the YouTube algorithm, and that's really helped the channel grow. So thanks to everybody that does that. So what's going on? A few weeks ago, we got some bad inflation data. Inflation was expected to come back, but it came back a little faster and a little steeper than the Bank of England were expecting. The expectations was that we would get inflation in May at 3.3%. It went to 3.5%, and it's expected by the end of the year to go to 3.7%. Now, the frustrating part on that inflation data is all of the inflation is caused by stuff that you can't control and I can't control. So keeping rates higher doesn't really make much sense to me, because you're squeezing lots of businesses, you're squeezing lots of homeowners when they're already being squeezed by higher costs. Now, the Bank of England would raise interest rates to control inflation and to curb spending, but we're not overspending at the moment. The data shows that businesses are struggling, retail sales are down, and lots more. So in the autumn of last year, we had the budget, and in the budget it was announced that we would have higher national insurance costs, higher business rates, and the living wage would also increase in April of 2025. Now, that's happened, and already we're seeing the consequences of that, and it doesn't look great for the UK economy. In fact, the goal of increasing this stuff is to make it so people have more money, but what's happening is they're losing their jobs. That's not going to be great for the UK economy. It's also not going to be great for the tax collected by the government, because if less people are working, there's going to be less national insurance paid, less tax paid, and they're going to have to pay the dole out to these people. So it doesn't really make logical sense. So let's talk about this. So unemployment at the moment is the highest since July of 21. So it's really not great. You think about where we were in July of 2021. We're just coming out of the pandemic at that point. And so there was a lot of uncertainty. Businesses had struggled. Yes, during lockdowns, they got bounce back loans, they got CBILS loans, they got the furlough scheme, but they didn't get customers paying them. And that meant that a lot of people were really, at that point, struggling, at least business owners were. And so the fact that we've got unemployment at that level is not great at all. And so wage growth is something that the Bank of England is concerned about still. So even though unemployment is rising, wage growth is still high and significantly higher than inflation. But that's changed as well. It's moving in the right direction. So wage growth has slowed down. And so it's gone from 5.5% down to 5.2%. So it's moving in the right direction. And I bet that trend is going to continue for the rest of this year. It just takes a while to feed through into the data, because these are rolling 12-month averages that we're seeing on all this data. What else is going on? Well, how many people lost their jobs in May? A lot. 109,000 people lost their jobs in May. Additional people. That's not great, and that's going to just keep steamrolling, isn't it? What about vacancies? Are there any vacancies for these people? Because losing your job isn't great, but if there's lots of jobs around, then you can go into that. Well, vacancies dropped as well, so that's not good. And this all really shows us that things aren't looking great with the economy. So we're 63,000 vacancies down in just 1 month. Not great. So what are the markets expecting now? Next week, we've got the Bank of England meeting, and it would make sense to a lot of people that we should cut rates, because the Bank of England and the Federal Reserve, they always act too late on this stuff. So what's the expectations on a cut in June? Pretty much zero. June cut is unlikely, and what this is being blamed on is Trump. Trump's getting blamed for this because we've got the uncertainty of the tariff war. What impact is that going to have on global business? It just takes so long for this stuff to feed through, because yes, he puts a tariff on, but companies have already got stock in their warehouses that they're selling now. The stuff that's coming at a later date that's going to have these tariffs on, that takes a while for that to feed through into the market. So that is a problem, that uncertainty. The best thing that could happen is the trade war just ends and everyone just carries on as we were in March. That would be the best option, but that's not what's happening at the moment. However, the markets are now pricing in that there is going to be a cut in August. So there's no July meeting, and the expectation is, and this is new data, is that we'll get a rate cut of quarter of a percent down to 4% in August. Now, what are the markets predicting going forward? They're predicting one further cut in 2025. That's good if you want mortgage rates to come down and you've got credit and you want to get loans and all these things. That's a positive thing for the property market. It's also positive because there are 500,000 people that are coming off fixed rate mortgages that got ultra low rates 5 years ago. We're talking about rates at 1%, 1.5%, 2%, that were going to get a real shock when they came into the market if they finished their rates a few years ago, 6.5%, but fortunately now we're looking at rates of 4%. But that could move down, which is pretty positive as well. So the bad news is that the reason that we're now getting 2 rate cuts priced into the market is the markets expect the UK economy to not do well. Unemployment to rise significantly. It's gone up just this month from 4.5% to 4.6%. That's a big jump. And that is going to impact a lot of people. They're not going to have wages. They're not going to spend on products and services. Businesses will ultimately suffer from that. And it starts a vicious cycle, and you can talk your way into a recession, and you're going to see lots of fairly negative press from the news talking about the unemployment and that it's rising, and that could mean more people lose their jobs, and hopefully this gets resolved as quickly as possible. What does this mean for the property market? Well, it means less buyers. It ultimately means that prices are going to struggle to go up for sure, and it could mean that some prices go down. So we've got to keep an eye on that, and we'll be sharing that each and every month that we get new data. What do you think the Bank of England are going to do? Do you think they're going to cut in June and defy everyone's expectations? Do you think they're going to cut in August, or do you think they're just going to keep holding indefinitely until they get even more data? Let me know in the comments below. Do smash like, do subscribe, do check out all the other content as well on the channel, including this video right here.